next chart. What is the correlation between Bitcoin and various other asset classes, gold being an important one of them? Well, you can see how low the correlation is. So a correlation of 1 means very highly correlated. A correlation of 0 means not correlated at all. A correlation of minus 1.0 means inversely correlated. When one goes up, the other one goes down. This correlation, since 20, is suggesting no correlation. And in fact, if you look across the top line there, the correlation with most other asset classes, Bitcoin versus any other asset class, very low. No correlation with bonds, almost no correlation with gold and REITs, very low correlation with commodities. The highest correlation is with the S&P 500, and even that is a low correlation. And you can look at the correlation between and among the various categories here. You know, Bitcoin's correlations are very low. And what this means is asset allocators have a fiduciary duty to look at Bitcoin and other crypto assets for portfolio diversification, because the lower the correlation, the higher, when adding one of these low correlated assets to the others, adding means return per unit of risk probably will go up. So we think this is a great illustration of that.
To the uninitiated, price action is chaos. To the seasoned analyst, it is information. While the retail market fixates on daily volatility, a deeper structural transformation is reshaping the global financial landscape. Bitcoin is no longer merely a speculative instrument. It is becoming a necessary component of institutional architecture. To understand Bitcoin's trajectory, one must first confront the consensus view on the US dollar. The market believes the dollar is structurally weak, but this ignores the mechanics of capital efficiency. We are witnessing a return to the dynamics of the early 1980s, where policy shifts drove a massive appreciation in the currency. In a world of a weakening dollar, asset correlations usually tighten, yet Bitcoin stands alone. The data reveals a reality that institutional investors can no longer ignore. Cathie Wood points out that observing the correlation with most other asset classes, Bitcoin versus any other asset class is very low. It has no correlation with bonds and almost no correlation with bonds and REITs. Even against the equity market, the highest correlation is with the S&P 500, and even that is a low correlation. This mathematical detachment creates a new imperative for asset managers. It is no longer a matter of preference, but of obligation. As Wood states, asset allocators have a fiduciary duty to look at Bitcoin and other crypto assets for portfolio diversification. The math is undeniable. Adding one of these low correlated assets to the others means return per unit of risk probably will go up. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Make sure to check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Now I'd like to talk about a big disconnect, given everything I've just said about inflation, between a lot of inflation indicators and the gold market. Gold prices have more than doubled in the last 2 years. And here you can see what an extreme they have reached on this basis. So this is the gold market cap as a percent of USM2. US being the world's reserve currency. And you can see that we have surpassed the gold to ratio in the late 70s, early 80s, when inflation was raging at a double-digit rate, and interest rates were into the double digits as well. So that's interesting. There's only one other time that this ratio has been higher, and it was during the Great Depression, during the 30s, when the gold price was fixed in the low $20 range, and money supply was collapsing. So those two things are not true this time around. The gold price has been going up and the money supply has been going up. And so we're trying to figure out what this means. One suggestion is that gold has entered, I hate to say irrational exuberance territory, but that's the prevailing phrase. Maybe gold is nearly done with this bull run. And then we have to ask ourselves, because Bitcoin is considered digital gold, has Bitcoin, is it done for a cycle? And as everybody knows, the 4-year cycle worry is out there. Well, here you can see the Bitcoin to gold ratio. In a trend sense, since 2020, you can still say, even though we did break the last higher low, in a broader sense, you can say, oh, maybe this is still in an uptrend. We shall see. But what we have found very interesting is on the next chart. What is the correlation between Bitcoin and various other asset classes, gold being an important one of them? Well, you can see how low the correlation is. So a correlation of 1 means very highly correlated. A correlation of 0 means not correlated at all. A correlation of minus 1.0 means inversely correlated. When one goes up, the other one goes down. This correlation, since 20, is suggesting no correlation. And in fact, if you look across the top line there, the correlation with most other asset classes, Bitcoin versus any other asset class, very low. No correlation with bonds, almost no correlation with gold and REITs, very low correlation with commodities. The highest correlation is with the S&P 500, and even that is a low correlation. And you can look at the correlation between and among the various categories here. You know, Bitcoin's correlations are very low. And what this means is asset allocators have a fiduciary duty to look at Bitcoin and other crypto assets for portfolio diversification, because the lower the correlation, the higher, when adding one of these low correlated assets to the others, adding means return per unit of risk probably will go up. So we think this is a great illustration of that. The other thing I'd like to say about this period of time, given all of the talk about the dollar being so weak, well, if we're right, the dollar is stabilizing here after a decline in 2025 and will reverse course, much like it did during the early 80s. In the early 80s, with Reaganomics, and we think that this administration's policies are turbocharged Reaganomics. Because of those policies, the dollar went up. Why? Because the return on invested capital in the United States went up relative to the returns elsewhere in the world. So we would not be surprised to see a sizable increase in the dollar here, which is completely away from consensus expectations, and therefore very interesting to us. Now, one thing we do have to think about as we're getting into talking about markets here is valuation. So in the purple, you see the PE ratio, trailing 12-month moving average of the PE ratio for the S&P 500 versus inflation. So we're back to this important inflation call. Now, if you look carefully, I know this is messy, but if you look at the early 2000s, you can see that because of the monetary and fiscal stimulus around long-term capital management in 1998, Y2K in 1999, and the tech and telecom bust in 2000, you can see that after inflation bottomed, it moved from roughly 1.5% up to 4.5–5%. And the PE ratio went down during the early 2000s. There is an inverse correlation between PE ratios. You saw it highlighted during 08–09 and the PE ratio. So you can see where we are now. I think it was instructive to see how low the valuation went in the purple there after COVID. We dropped to 17, 18 times earnings. Now, that was a big correction during COVID. And there was a very rapid expansion in earnings after COVID. So it was interesting to see where this stabilized around that 17, 18 range. Now, why would that be? Could it be that the market in its wisdom is saying, hey, wait a minute, we think inflation is that the next big move in inflation will continue to be down? Maybe. You can see the PE has gone up as inflation stabilized. And I think that surprised a lot of people. Could it be the market is discounting another drop in inflation? And that would support valuations. Now, I'll quickly add that if we're right on the outlook for earnings and revenue, GDP growth, then we're going to see very rapid growth during the next 2.5 to 3 years, very rapid growth. And so we believe that we don't have to assume these valuations hold. We think that the revenue growth and earnings acceleration that we're going to see, especially in the innovation space, so consider the source, that's all we do, that they're going to overwhelm the high valuation by historic standards and help us deliver a compound annual rate of return well north of the market during the next 5 years. So stay tuned. This has been a big tease, that green line representing inflation recently. The recent stabilization / slight increase has been tariff related. We think that's working through. And we think that the resolution of the green line will be to the downside, probably negative.
This brings us to the question of value rotation. Gold, the traditional hedge, appears overextended. Prices have doubled in recent years, and relative to the money supply, gold is trading at levels not seen since the inflation crisis of the late 70s. Wood suggests that gold has entered irrational exuberance territory. The prevailing signal is that maybe gold is nearly done with this bull run. This exhaustion in gold presents a pivotal moment for digital gold. And while the market worries about Bitcoin's 4-year cycle, the trend suggests a different story. The decoupling of Bitcoin from gold is significant. As Wood notes, Bitcoin's correlations are very low, positioning it as the primary beneficiary for capital seeking true diversification away from a crowded gold trade.
You can see, I think we still have to see this metals to gold ratio turn around to confirm that we're in an upturn in the cycle. And it is, for me, the most interesting chart because, these two, the long-year Treasury bond yield in green and the metals to gold ratio, have been so highly correlated in the past. They've broken apart in recent years. So maybe they'll meet somewhere in the middle during the next few years. Here's copper. Copper is telling us, okay, maybe we're now resuming the cycle. And a lot of manufacturing facilities, anything going electric, demands more and more copper, including transportation. So this is also a secular shift towards copper, which should benefit the price. Here to end are what we've been monitoring, just keeping us on our toes, the S&P to gold ratio. Still basing, it's at the lower end of a base that's been in place for the last 5 to 10 years. We do not think it's going to end up like it did in the 70s. We think instead that the S&P to oil ratio is leading the way, and that is heading for new peaks. That's very, very bullish. We had, if you look at 1980 through 2000, that's the strongest and longest bull market in history. Sure, we had episodic setbacks, but the most powerful. And if we're right, then that the Trump administration is Reaganomics on steroids. This should break out, and we believe the S&P to gold ratio will follow. Here are long-term interest rates. Interested to see how much of this deflationary undertow long rates will telegraph long-term. We wouldn't be surprised to see long rates back into the 3% range in an inverted yield curve environment, which, and we'll get into this in the letter that I've written, but if you look back at the last time we were in an innovation cycle like this, late 1800s, early 1900s, the yield curve was inverted almost all the time, on average by about 100 basis points and up to 500 basis points. And that's because short rates were following nominal GDP growth, but long rates were much more focused on the deflationary impact of these new technologies. So I will end up on this.
Finally, we must address the economic engine itself. The market fears that rapid growth will reignite inflation, but this view is outdated. Wood challenges this directly. Growth does not cause inflation. In fact, productivity-driven growth is associated with falling inflation. We are entering a period where revenue growth and earnings acceleration, especially in the innovation space, are going to overwhelm the high valuation by historic standards. If the analysis holds, and we are indeed seeing Reaganomics on steroids, then the breakout in risk assets is just beginning. Bitcoin, sitting at the intersection of innovation and monetary independence, is not just a trade, it is the structural answer to a changing world. The cycle has not failed, it has evolved. The signal is clear for those listening. When correlations break, opportunity forms. That's all we have for today. Please make sure to like, share, and subscribe, and we'll see you all in the next video.